You've probably seen the headline, Europe just passed its first tax on gains you haven't cashed out. 36% on profit that never actually reached your bank account. It went everywhere. There's just one problem with it. It didn't pass. But here's the part nobody put in the headline, and the part that actually matters if you invest in Europe. Two countries are already doing this, not proposing it, doing it right now to ordinary investors. So let me show you what's real, what isn't, and how to work out where your own country actually stands. Hello, I'm Wealthy in Europe. Welcome back. Quick note before we start. This is educational information only, not financial advice. Tax rules differ enormously between European countries and they change constantly, so treat everything here as an explanation of how these systems work, not a recommendation. And because this one involves live legislation, everything here is accurate as of August 2026. Always check the current position with your own national tax authority or a qualified advisor. Let's start with what we're even talking about, because the phrase unrealized gains does a lot of quiet work. Normally, investing tax is simple in principle. You buy something, it goes up, nothing happens. You sell, you take your profit, and then you pay tax on it. That's a realized gain. Realized because you actually turned it into money. An unrealized gain is profit that exists only on your screen. Your fund went up €8,000 this year. You didn't sell. On paper, you're richer. In your bank account, nothing changed. Now imagine a tax bill arriving for that 8,000 anyway. That's the entire idea. Tax authorities call it mark-to-market. Once a year, they compare what your portfolio is worth to last year and tax the increase, whether or not you sold a single unit. Before we go country by country, we need to do the one thing almost nobody online does properly, because if you get this wrong, everything else you read is noise. 4 completely different taxes all get called the wealth tax or the unrealized gains tax, and they are not the same thing. Number 1, capital gains tax. You pay when you sell. That's the standard across most of Europe. Number 2, an annual tax on unrealized gains. You pay every year on paper growth, sold or not. That's the one we're here for. Number 3, a wealth tax. That's a tax on the total value of what you own, not on your gains at all. Spain, Switzerland, and Norway have versions. And number 4, an exit tax. Unrealized gains taxed at the moment you emigrate, triggered by leaving, not by the calendar. Norway, Denmark, and Germany all have one. 4 mechanisms, 4 different triggers. So whenever you see a scary headline about European taxes, your first question should be, which of these 4 is it actually talking about? Because half the time, the headline itself doesn't know. So, the Netherlands. Here's what's true. On the 12th of February 2026, the Dutch lower house approved a bill that would tax actual returns on financial assets, savings, shares, bonds, and crypto, at a flat 36%. And crucially, that includes unrealized gains, revalued every year. Property and startup shares would stay on the old sell-to-pay basis. There'd be a tax-free return allowance of €1,800 a year, and losses could be carried forward indefinitely. And it was never going to start immediately. The target is January 2028. So far, so headline. Here's what got left out. It then went to the Dutch Senate, and the Senate did not pass it. The final vote was postponed because there wasn't a majority for it as written. One senator moved to withdraw the bill entirely. The government is now rewriting it. An amending bill is expected in September 2026, and the Senate isn't due to pick it up again until around January 2027. And the changes on the table aren't cosmetic. A lower rate of 35%, a higher allowance of €1,900, and the ability to carry losses backwards as well as forwards. So the honest summary is, approved by one chamber, stalled in the other, being rewritten and aimed at 2028. That's a very different sentence from "it just passed." And one thing worth knowing because it explains why any of this is happening. The old Dutch system taxed people on an assumed return, a number the tax office set regardless of what you actually earned. In 2021, the Dutch Supreme Court ruled that unconstitutional. So this isn't a government inventing a new way to tax people. It's a government being told its old method was illegal and reaching for the other extreme. Now for the part that isn't hypothetical at all. In Denmark, this is simply how investing works, and has been for years. It's called lagerbeskatning, inventory taxation, and it's mark to market, exactly as we described. Every year the value of your funds is compared to the year before, and the growth is taxed. Sold or not sold doesn't matter. For exchange-traded funds on the tax authority's approved list, that growth is taxed as share income, 27% up to about 79,400 kroner of gains, and 42% above that. Funds not on the list are treated less favorably again. There is one softer route, a dedicated stock savings account, taxed at a flat 17% a year, but with contributions capped at around 174,000 kroner. Notice what that means in practice. A Danish investor who buys a global index fund and never touches it for 20 years still gets a tax bill in every one of those 20 years. No sale, no cash. A bill. This is the system the Dutch proposal would move toward, and it's been running quietly next door the whole time. And the second one we've covered in depth before. Ireland does the same thing on a longer fuse. Irish investors don't get taxed every year. They get taxed every 8. On the 8th anniversary of buying a fund, the tax authority treats it as if you'd sold it, and charges 38% on the gain in cash, while you still own every unit. Then the clock resets and starts again. It's the same principle as Denmark, just spaced out, and because it arrives all at once, the bill tends to be a lot bigger when it lands. If you want the full breakdown of how that one works, there's a whole video on it on the channel. Let's make this concrete, because the real problem here isn't the percentage. You might remember Maria from earlier videos. She invests monthly into a global fund, automatically, and leaves it alone. The boring strategy that works. Now put Maria under one of these systems. Her fund has a good year. On paper she's up several thousand euro. She hasn't sold anything, doesn't intend to for another 20 years, and her salary hasn't changed. Then the bill arrives, for tax on money she never received. She has two options. 1. Keep spare cash on the side, every year, purely to pay tax on gains she hasn't taken, money that isn't invested and isn't compounding. 2. Sell a piece of the investment to pay the tax on the investment, which is the one that quietly does the damage, because every unit she sells to pay that bill is a unit that never grows again. That's the actual cost of taxing unrealized gains, not the rate, the timing. Being asked to pay in cash for a profit that only exists on a screen. So, is your country next? I'm not going to pretend to know, and you should be suspicious of anyone who does. What I can give you is a way to find out where you actually stand in 3 questions. 1. Am I taxed when I sell or every year? That single question separates most of Europe from the Danish model. 2. If it's every year, is it a tax on my gains or on my assets? Those are the 2 very different things people keep merging into wealth tax. 3. What happens if I leave? Exit taxes are a separate rule again, and they're the one people discover far too late. Norway is the clearest example. If you move away holding unrealized gains above 3 million kroner, they're taxed at just under 38%, and since a 2024 tightening, you have to actually pay within 12 years, even if you never sell. Germany and Denmark have their own versions. None of that is triggered by a calendar. It's triggered by you moving. Ask those 3 questions of your own tax authority's website. Not a headline, not a forum, and not a YouTube channel, including this one. And check the date on whatever you find, because as the Dutch story shows, a rule can be reported as settled while it's still being rewritten. And once more, because with tax it really matters. Everything here is educational information only, not financial advice. The rules differ in every country and they change. So verify your own situation with your national tax authority or a qualified advisor before you act on anything. If this untangled something the headlines keep getting wrong, hit subscribe. It genuinely helps the channel. Thanks so much for watching, and I'll see you in the next one.